My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Up here, my friends, I'm just trying to save you a little money. My job is not just to entertain you, but to educate. Put days like today in context. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. You might believe you own a portfolio of totally diversified stocks, but if you lost a ton of money today, you're probably not as diversified as you think. That's because high-flying stocks are a category by themselves, regardless of what sector they belong to. And on days like today, the high flyers, well, they all get slaughtered. They fare much worse than the averages. So after the sell-off, where the Dow lost 451 points, S&P declined 0.43%, and the Nasdaq shed 0.47%, I want to prove that you need to think twice before you pile all of your money into the most volatile stocks out there, the momentum plays. I mean this especially for some of you younger investors who use options and ETFs to make what amounts to bets on these stocks, because I know you got your clocks cleaned today. See, you never want to lose a huge amount of money in any one day, because the real challenge in this business is convincing yourself to stay in the game. And nothing is more discouraging than seeing everything you own get clobbered. So let's talk about speculation, informed speculation that can lead to big-time investing as long as you are disciplined and don't roll it all into the highest of flyers and nothing else. The most speculative stock in this entire market right now is Palantir. That's a data analytics and artificial intelligence company that is loved, 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 especially by young people. I'm basing that speculative crown on its ridiculously high valuation, with the stock selling for 197 times this year's earnings. And that's after falling nearly 15% over the past 2 trading sessions. Now, I am a big believer in Palantir as a decent spec. I've listened to Alex Karp, the charismatic, borderline messianic CEO, talk about how the company should be valued by the abstruse rule of 40, where you add its revenue growth rate to its operating margin. And if you get a number north of 40, well, then you've got a good business. Well, in the last conference call, Karp said Palantir's sales growth rate and its operating margin together added up to 81%. 81 is the best in the entire market. Does that mean it's worth 197 times earnings? Not on a daily today. This consulting and data interpretation company, among so many other things, does a huge amount of business with the Defense Department. And we're now hearing chatter that the defense spending could be cut back by 8% in each of the next 5 years. Now, I could make the case that Elon Musk, the head of Doge, might actually appoint Palantir to cut the fat. Or you could easily argue that Congress and the courts will never let the defense budget get cut without an actual piece of legislation. But today that didn't matter, did it? The stock, which had gone up for weeks, gave back a huge amount of money in the last 2 days. Why? Now, some of it was the Defense Department rumor, but some of it was simply that Palantir has gotten too expensive, which is why we're starting to hear chatter about insider selling plans. It actually doesn't bother me, though. See, most of all, what really happened is about the shareholder base that turned tail. Palantir is mainly owned by retail investors who are true believers. They love Karp and his irreverence and his braggadocio about how everyone at Palantir is much smarter than you and I. They think this stock belongs to 1,000, not at 106, where it went out today. Is there some metric to justify that price? None whatsoever. For the owners, the traders, it's all about charisma and brilliance. And take their word for it. They do tremendous work for customers, work that pays off soon after you hire Palantir. Now, most of these kinds of shareholders don't intend to sell, but it gets a little too dicey on days like today and yesterday for most owners. That's because there's another cohort of owners, red-hot mutual funds, who are addicted to stocks like Palantir. There are managers who are mesmerized by things like the Rule of 40. They buy into every cockamamie method of valuation. They have total contempt for those of us who like to have some rigor, some methodology that can make it so you can buy a stock and justify buying more on the way down as it gets cheaper. These managers are not investing. They're simply taking chances. And as long as they do so somewhat wisely with a plan to buy more on the way down while measuring each quarter for the showmanship, well, then maybe they got a winner. But on days like today, let me tell you, they are your worst enemies if you own stocks like Palantir. Because when I see all of these kinds of stocks go down at once, I know that some big-time money managers are bowing out. They've gotten bearish, and they're taking every one of your stocks down with them. Remember, I have no problem with this kind of speculation. I've been telling people to buy Palantir in every dip if they're willing to take the risk, including, by the way, this one. I actually am encouraging you to pick one or two speculative names. That's all. And own them. Have no illusions. If they don't work, you'll be up speculation creek without a paddle, which is why I don't want to own 5 or 6 of these. Then why am I even countenancing this kind of activity? Well, because when it works spectacularly. Take Amazon. Hard to believe now. But for years, I heard that Amazon was ridiculously overvalued, endlessly. I was willing to go long it after spending some time with them, publicizing Confessions of a Street Addict in 2002. I saw that they could easily wipe out the bookstore industry, maybe even the rest of retail. But I recognized it was speculative. If you had conviction, it made you a fortune. Netflix and Tesla is no different. They looked incredibly expensive the whole time. At certain moments, you had to suspend any sort of sense of rigor or prudence to own the stocks. And you had to hold on for dear life on days like yesterday and today. Most investors I know can't do it. Or they do it in options, and now they're done. They're done. They have nothing left. Yet there are some amazing opportunities all over the place if you're patient. Take Carvana, which reported last night, saw its stock plunge 12% today in response. At no point could this stock be justified on the basis of any metric, earnings, sales, rule of 40, nothing. But when I used it to buy a new car, which we didn't like when we got it, they took it back. They said nothing. I was sold. Carvana was in single digits back then without a good balance sheet. It took a restructuring and infusion of capital to turn things around. But last night, the company reported a quarter that many thought was weak enough to sell. I disagree. And even after this decline is settled at $247 and change, nice run from the single digits of years past. How about Cava Group, the restaurant chain that may be the next big thing because it sells fresh, healthy Mediterranean food for a reasonable price? Of course, the stock trades at 191 times earnings. Who can possibly justify that? Only a person who believes that Cava could be the next Chipotle, one of the greatest performers of all time. You put $1,000 with the Chipotle, into Chipotle when it came public, $120,000 now. How about AppLovin? Here's a company that links mobile game advertising with players. It was the best performer in the NASDAQ 100 last year, up over 700% for the year. It looked like the most expensive stock in the universe. But then when we saw the quarter not that long ago, it turned out that AppLovin was making a fortune. It now sells for just 68 times earnings. Sure, that's a lot, but it's much cheaper than it used to be. You have to stick with it through days like today when it closed down. Most cannot do that because they own 5 or 6 or 10 of these kinds of stocks. And those people were obliterated, and they don't know what to do other than turn off the TV, stop investing, and there you go. Now, let me go back to what I said at the beginning. If you believe in these companies and you can stomach dicey balance sheets, you should by all means, own a couple of speculative stocks. Keep in mind, many of your fellow shareholders will want to cut and run when they see all their stocks clobbered. Meanwhile, there are professionals who own nothing but speculative stocks, and if they choose to look at it all at once, as is the case we saw in the last 2 days, you can be annihilated. That's why, even though I am the only person I know who comes on TV and actually recommends speculation, albeit in an informed way, I urge you to diversify your portfolio beyond speculative stocks, because these things all trade together. Bottom line here, my primary goal in this show is to keep you in the stock business. I want you to stay in the game. I can't do that if you own nothing but Palantir, Carvana, and AppLovin, and all the others that trade, and you trade nothing but options and ETFs that include them. At the end of the day, you simply won't know what hit you, which means the next time we get a day like today, I don't want you to sell everything and possibly give up on the entire asset class. If you have just 2 of them, though, you'll make it through and be able to buy more into weakness that everyone else is fleeing because they can't take the pain. But you'll be able to. Let's go to Masood in Maryland. Masood.
Greetings, Mr. Cramer.
How are you?
I'm doing great. Kind
Fantastic.
of cold. I'm previously from Miami, so it's...
All right. Sounds good. Sounds good. Mm-hmm.
I'm a long-time listener from your era, co-hosting with Larry Kudlow. I'm a first-time caller.
Thank you.
I really appreciate all the knowledge you share with your audience.
Thank you.
I have a pretty good portfolio, about 31 stocks, and I'm up about 38% in 18 months. So doing good there.
It's fabulous.
I've been taking your advice of easing into buying the stock like 25% of what I want to buy at a time.
Perfect.
Done my due diligence. The chart looked good. So I bought 5 shares of BlackRock, BLK, on February 4th for $1,049. It went up a couple of days to all-time intraday high of like 1,084. and immediately started going down almost every day.
Yes, it did. Yes, it did. And we own it for the Travel Trust, and Jeff Marks and I talked about it extensively today when we did our meeting. We had our club meeting. It is online. We feel, and we just bought more. We think it's a great price. We don't think this stock can underperform that much longer. It's that good a company. But thank you for your call and for your confidence. Look, I'm all for owning a couple of speculative stocks, but you have to make sure your portfolio is diversified. It's the only way after a day like today that you'll stay in the game. Mad Money tonight. Can coffee chain Dutch Bros, there's one up, just like the ones I just talked about, can that stay caffeinated for the long term? I'm checking in with the top brass after last week's post-earnings pick me up. Then denim maker Contour Brands just announced, in addition to its apparel portfolio, I've got the CEO to talk through the deal and his pre-announced quarter. You will not want to miss it. And later, safety science player UL Solutions, you might know them as Underwriter Laboratories, pulled back on today's earnings beat. I'm taking a closer look because I think this might be an opportunity. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.